I don't think the lows are in. I think you could get the rally going on a little bit further because December 13th is the next CPI print. Remember, the CPI print triggered this. The next CPI print we once again think is going to be with core below 0.3%. So we're looking at 0.28. So that, given where the euro-dollar strip is priced right now, remember the Fed is still priced for 3.75 or thereabouts all the way out to 2027. So the market's looking for very restrictive Fed for a very long period of time. The market's either thinking higher R-star, or the market's thinking that the Fed is going to keep real rates restrictive for a very long period of time. That needs to come down a little bit more, right? And I think that will come down a little bit more with the next few CPI prints, which are coming down. But then that helps your PE. Your PE is already heading back to its sort of 17 and so on. That helps your PE, but then you have to grapple with the question of E, right, which is earnings and which is heading towards a recession. It needn't be, we don't have the necessary conditions for a deep recession, but we have the conditions where global growth is going to be very weak, right? We're looking at between a third and half the countries globally that we cover being in recession. So it's an inch deep, but it's a mile wide. And global growth is at 2%. That is not priced into stocks.
And then that's, look, there is always a difference in the E response to a downtick from US companies and Europeans as well. They seem to be more adept at being nimble in the US. That's history talking, not me. Is that going to be the case this time around as well? That actually, if we do have this earnings downtick and we do see the markets coming off a little bit, there's more opportunities perhaps stateside because they are more nimble at managing their costs. Unfortunately, they have more, well, fortunately or unfortunately, whatever way you want to look at it, very flexible labour markets. They can react very, very quickly. Europe tends to be a bit slower out of the blocks.
I'm going to be a bit boring and start by looking back first, right? Yeah. So this year, which was a year where Europe was going to be in serious trouble, Euro stocks has actually outperformed the S&P.
Now, why is that?
The correct statement actually is that S&P has underperformed Euro stocks. So it's not potato potato. It's because
is that because of the growth stocks became so important in the S&P?
It's because this was a valuation year. This was a year where your risk-free rate, your real interest rate, your two-year real rate moved by 500 basis points. So this was a de-rating year. If the next year, and life's not zeros and ones and it's not black and white, but if the bulk of the problems next year are going to be E, then Europe is more in harm's way than the US. So we're looking for pretty ordinary returns in equities, full stop, because the price of bonds has gone down, the yields have gone up, and therefore the equity risk premium on offer is actually quite low. There is a competing asset class, so it's not 60-40, it's more like 35-65, if that, right? Or perhaps even lower for equities. And bond allocations are going to be quite high. But within the context of equities, the US equities will probably do better than European equities next year, in contrast to what happened this year.
Bhanu, when it comes to the cyclical and defensive trade-off, and you point out that what cyclical is only lagging defences by 7% so far, and that would normally be deeper, has the equation changed because of COVID? And we saw defences were not defensive during COVID. Traditional names were sort of hit really by a health crisis. Do you think that's still a hangover? Because even though nobody's talking about COVID other than in China, there is still the what if it impacts the sector down the track.
I think you're right. I think it has happened because of COVID, but maybe for slightly different reasons than you imply, which is that because we've had such a large commodity squeeze, COVID, fiscal, large S, commodity squeeze, a lot of the commodity cyclicals did extremely well. Some materials and energy, these are sectors that most people would consider cyclical. These are sectors that have done extremely well, and that's why cyclicals have kept up at such a high level. Financials gone into this with pretty decent balance sheets. You're very well provisioned. You don't have major problems with your capital, and as a result, financials have also done well. So some of these sectors, thanks to COVID, have done quite well. But this story then begins to change as you move towards global growth of 2%, which is as close to a recession as you can get. And next year, I think it's going to be much more defensive than it's going to be cyclical. So your classic utilities, tech, potentially healthcare, these will probably do much better than, and even some parts of the consumer will do much better than the producer side of the economy, which is materials and industrials and such.
Hi, I'm Bhanu Baweja, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.